thousands of chart patterns out there and it's overwhelming for beginners. If you can't tell the difference between head and shoulders or an inverse falling wedge, this video is for you. With this video, we're only covering the 3 most important and simplest chart patterns and how to trade these profitably for a beginner. Now, if you're somewhat new to trading stocks or reading charts, here's a quick refresher. Stock charts show trading history. Each candle in a chart represents a time period and the price movement, whether it's a month, a day, a week, it could even be 5 minutes. My personal suggestion, if you're a high frequency trader, those short-term time frames like 5 minutes, 3 minutes, 1 minute makes a lot of sense. But for most beginners, I would actually recommend that you take your time and actually look at daily charts, weekly charts, or even monthly charts. These tend to be a lot more predictable and they ride out volatility a lot better. For any chart pattern, you will need to know the basics of support and resistance. And I made a previous video on that, which you can check out here. But with support and resistance in mind, let's tackle the first chart pattern here, the channel. And no, I'm not talking about this channel, but rather this one. When we think about chart patterns in stocks, the channel is the perfect example of price fluctuations over a period of time. It's like a game of Pong where the price is bouncing back from a low to a high and a low to a high, but generally staying within a defined range of motion. Generally, when you trade stocks, it's much more simple to go with the trend rather than against it. So in this case, when we look at a channel pattern, we're trying to see where we can get in this case, the support if you're buying the stock, and where we would like to sell. In this case, that would be the resistance. Now, on the flip side, you could also, at the resistance, buy something like an inverse ETF or buy put options so that you're betting that the stock is going to go down and thus profit from that. This is a more advanced strategy. So if you are indeed a beginner, I would focus on just buying at support, going long on the stock or maybe call options, and then selling at the resistance. Either way, if you're going to trade the channel pattern, make sure to set a stop loss below your entry point so that if the stock finally breaks out of this predictable pattern and it, maybe shoots down or shoots up, you want to make sure that you're protected and you don't take a big loss. Here's an example of one trade that I did in a channel pattern. You can see with STZ, this stock traded between this range of about $200 to $260 for a long period of time. What I did was I got in at the support around $208 per share, and you can see the risk reward that I set up here is about 3 to 1. So in this case, it was a very profitable move. The stock has been bouncing back from that support back towards that resistance way up there. And we'll see where it goes, but it has been a very nice trade using the channel pattern. And hey, if you're getting a lot of value out of this video so far, make sure to check out our Stock Dads Discord. We have a whole lot more in depth in terms of educational courses, one-on-one mentoring, real-time live trading alerts, such as the one that I just mentioned, and a whole lot more. Check out the link in the description or stockdads.com. Next up is one of my favorite patterns, the double bottom. Oh yeah. Okay, let's get our minds out of the gutter here. But the double bottom in terms of stock charts is going to be when a stock hits a previous low and bounces back from that. You often see a W pattern on the stock chart. So you can see that the stock has hit this price level in the past. It reaches that price level once again, and buyers step in to push that price back up. This is also known as a reversal pattern because, again, a downtrending stock meets buyers and then it goes right back up. And oftentimes in an uptrending, long-term uptrending stock, this double bottom means that it will continue to go higher and higher, make new highs. Now you can trade this one of 2 ways. You could buy at the support level or near it when you start to see a green candle and maybe another one for confirmation from that support level. And oftentimes you see a pretty big bounce too from that level. You'd get in at that price point. Another approach is going to be buying in at the middle of that W. So when the stock goes down to that low, bounces back a little bit, down to that low again, bounces back again. Once it crosses that previous lower high in between and starts to go higher, that could be also a buying signal. With either approach, you're going to make sure that you set your targets on the upside at previous highs. So you're going to look to the left of the chart. You're going to see where was the last points where the stock hit a resistance and it sold off. Sellers stepped in and put pressure on the stock and drove the price down. When the stock gets back up to that previous high, the same thing might happen again. Even though this is a pretty reliable reversal pattern, it's not always perfect. You want to make sure that you set strategic price targets and take some profit off of your trade. Here's a recent example with JetBlue. You can see that there was a previous low, almost a perfect double bottom here, and it has since bounced back really fast. Same thing as the first trade with the channel pattern. You want to make sure that you have a good risk to reward ratio. Make sure that it's worth taking the trade. You don't want to get into a trade where you don't have a lot of upside and then stock pattern might break down and then you lose money. And finally, third and last is going to be the double top. And this is gonna seem pretty familiar if you just watch the double bottom, because essentially this is double bottom just flipped upside down, okay? So instead of two bottoms or two lows that were hit and the stock bounces, with the double top, it's going to be the stock hitting a previous resistance point, a previous high, and it goes back down again. This is not good. It's a bearish sign. It could happen as a reversal pattern as well in an uptrending stock that meets resistance, and this is a pretty good sign that it's gonna keep trending down. It's a new downtrend. How you play this is pretty similar to the double bottom, except the opposite. Once you see the stock hits a previous high and you have those red candles, maybe 2 in a row, 3 in a row for confirmation, or just a big engulfing bearish candle, that's your signal to get put options or short the stock. Price targets are going to be at previous support levels. So once again, look to the left of the chart, see what support levels are significant. Maybe the stock has bounced 2 or 3 times from that point in the past, and it might bounce from there again. So be careful with that. And once again, make sure that your risk reward ensures that it's worth taking this trade. Here's an example of UNH stock, United Health, where the price reached about $550, went back down, retested that $550, and went back down again. And it actually almost made a triple top here, and it continued to make lower lows now for the past couple of weeks. So in this example, you can see that it could have been a profitable trade if you bought puts every time the stock hit about $550 and failed to really make any new highs. And since that previous high, the stock has gone down about 10%. So there you guys have it, channels, double bottoms, and double tops. Focus on trading these 3 chart patterns profitably before you move on to other chart patterns. These need to be your foundation. If you want to learn more, once again, we have the Stock Dad's Discord, a full library of on-demand videos, live streams. We have one-on-one mentorship and live trading alerts. Be sure to check it out. Hope to see you in there. Make sure you subscribe to this YouTube channel so you don't miss a single video, and I'll see you in the next one. Take care.